And another point that's interesting to keep in mind is there's been such a rally in the public stock market at a level historically that is not sustainable. How does a lot of that sort of exuberant feeling, where you think about a lot of individuals that, wow, there's noise, there's challenges, the economy rallies, there's COVID, the economy rallies. So I think people have built a resilience against fear and concern. But as this gets more and more, there's a reasonable part of the population of people that graduated from undergraduate school post the great financial crisis in 2010 that have never really experienced a recession. They've never really seen what it's like to have friends not have jobs. They may not have a job, trying to find a job when nobody's hiring. And it's interesting. We talk to people about that and say, how do you think about that? Is that a concern? Well, not really, because they've never experienced it. Mm-hmm. Whereas, other folks that have lived through recessions and environments and know how dramatic that is. I remember when I started at Citigroup, they had just let go of 50% of the analyst class. And then you're going out to market, or people that that happen to are going out to market to look for a job, and nobody's hiring. Things get very real very fast, and that sends an extreme tone of fear and concern and so forth to people. And so I do wonder if all of a sudden this psychology starts to have people pull down, because there's been certainly a lot of momentum-based investing and things of that nature. And so it'll be interesting to see how that plays out. And your points around bond market and rates and so forth, how does that impact public markets, especially the concentration in a lot of big tech companies, many of whom have a lot of their components coming in from Asia and China and selling into those markets as well. So those are, I think, some really big things for us all to watch out, because that obviously can impact the whole economy as well, but certainly public equity markets.
I think that's very important. The other thing I would make as a corollary point here is that if we do have this dislocations, market economic, and if we have a recession, it's policy induced, which frankly hasn't quite happened before. And I don't Fed policy. We have many recessions that are Fed policy induced, but it's induced by the executive branch, which is kind of unprecedented. That's, you could say that's negative, but the silver lining to that is it's actually relatively easy to reverse. Of course, if the damage is done, that's harder if you have unemployment. But again, policy, especially on tariffs, it can be reversed. It already is being reversed. As we said, there is a Trump put. I mean, if there's more pain, there is a way to actually rein this in, to focus on different policies. And while Trump himself is pro-tariffs, and you have a pragmatic and a more dogmatic wing to his economic team, the more pain you have, the more the pragmatics win. So, or the pragmatic side of even of Trump's own views wins. So I think that the interesting thing about this, as opposed to a normal downturn or a normal shock, is it's reversible.
Yeah, and that's one of the things for the U.S. economy, being the biggest economy in the world, and the way that it gets to operate, and the resilience and sort of entrepreneurial nature of the U.S. economy tends to give it advantages to work through different challenges. What'll be interesting, we talk about Europe and different smaller countries and challenges, and you've got the inefficiencies of laws, languages, currencies, and so forth. I do have some concern of how much fragility there could be in certain areas. And I know, Dan, you've got a lot of awesome content here. Maybe to just give people a great kind of quick run through some of the extra information, and they can follow up later. Now that we've framed a lot of information, maybe we'll let you run through some of these final slides, just highlighting some great content and data that'll tease people to, I'm sure, want to dig in deeper and learn more from you. Thank you.
Thank you. So just, really quickly, I'll rush through some of the slides that I think are interesting. The first one is, if you look at geopolitics, the other thing I would point out that longer term, if we have more geopolitical tensions building up, especially with US-China, geopolitical tensions tend to be inflationary. And this goes from 1940. So all the peaks of inflation in the US have basically coincided, except for the great financial crisis, with some sort of geopolitical crisis, which of course ended up built up to it. So that's something to keep in mind. Again, this is longer term. We actually don't think inflation will go up. You could have this one-time bump, but longer term, if geopolitical tensions do not subside, and as we said, that's a possibility, this is something to watch for. Now, in investment geographies, what's stronger, what's weaker? I don't think there will be a war over Taiwan. The tensions, of course, are increasing because of the tariffs, which are at an embargo level. Chart on the left shows that. Average tariff rates, are effectively an embargo. I think there will be negotiations. They should come down, but they do create and they do bleed into the geopolitical tensions. The situation between mainland China and Taiwan becomes more tense. I don't think we're going to have a war. I think the costs around that and nuclear deterrence, frankly, keeps that from happening. You have the U.S. strategic three-island chain, the map on the right, which I think the U.S. will, at least theoretically, has a strategic ambiguous relationship with Taiwan, but you will have higher tension. And I think that Taiwan conflict, while unlikely, it's more than a tail risk, which it was, I would say, at the end of 2024. Something to watch. Again, unlikely to happen. The trade war between US and China, the interesting thing is that two populations that tend to think that trade wars could be won, and that tariffs are not all that bad, tend to be in the US and China. Relatively speaking to other countries. So that, again, that says that this could continue for months. I think they're starting to negotiate. I would say that the strength in this sort of trade war from the US perspective is the fact that other countries have an incentive to ally with the US because of fears of a China shock 2.0 and China exporting cheap manufacturers. Europeans are worried about this. Most other countries are, even Brazil, Chile are imposing tariffs. These two charts show the Chinese growth model, which is heavy on exporting manufacturing, and shows that most geographies and countries run increasingly higher trade goods balance deficits with China. So if the United States is able to put away its trade conflicts with Europe, with Canada, with Mexico, with Japan, then these countries could ally with the US because frankly, they fear this more than they're upset by the things that Trump says, which are, you could say, not standard diplomacy. China, of course, has a lot of cards to play as well. It's less dependent on US exports than it was, chart on the left, and it exports some stuff that the US cannot really get easily from elsewhere, specifically rare earths. So it has leverage. We don't know how the trade war will pay. At the end of the day, a trade war is a pain game. Who can tolerate politically more pain? And that's the jury's still out. Hopefully we'll have negotiations, those would end. These charts on this slide show that decoupling is hard to do short term. Chart on the left shows bottom panel, absolute levels in trade. They're too high to drop immediately, even with the tariffs. So there has to be a negotiation. Trade with China will drop as a percentage of total trade for the West. I have Europe, Japan, and United States here. And of course, for Western investors, portfolio and FDI into China will become more challenging. And the US may put in place more, again, restrictions on that. The other thing here is, of course, Europe, as you mentioned, in terms of geographies. I think China, just to say one word on it, they're going to do stimulus, they're going to devalue their currency, their equities could do quite well. Of course, they have their own domestic problems, they have their own fragilities and exposure to trade war. I would say that Europe, again, assuming they avoid a trade war with the United States, which would be quite damaging, cyclically should do well. Because again, they're spending more. You have the fiscal stimulus, you have it in Germany, you have military stimulus at the US, at the EU level, the chart on the left. Which shows that Germany has room for fiscal expansion. They're spending more on military, this kind of military Keynesianism. At the same time, European equities for a while outperformed the US, chart on the right, but of course they got caught in the trade war. Now, if the US and Europe solve their trade war situation, I suspect they will, but it will be choppy and it's, there's a high risk they won't. But if they do solve that, I think cyclically Europe will do well. The euro stands to appreciate, especially as the dollar weakens. But structurally, if you take a longer term view, Europe still has problems. As you said, regulation, different languages. They don't have a common fiscal policy. I can go on and on with all the things that we know. So the chart on the right shows the decline in real GDP, labor force, and productivity since 2000 in the Eurozone relative to the US. Whereas the chart on the right, and I could have shown electricity prices, shows that, again, electricity and gas remains expensive for Europe. So that's obviously a big headwind for their own industry. So in that sense, I think they continue to have structural challenges, but again, on a year or two basis, again, given the fiscal stimulus in Europe being considerable and more likely coming, Europe could do well cyclically. Now, in terms of the US, I think it has advantages in terms of labor flexibility, innovation. It's the largest consumer market. Will it reindustrialize? Well, it's hard to reindustrialize. The reality is you can bring back capital-intensive but not labor-intensive industries. Most countries, as they develop manufacturing as a percentage of GDP drops, even with China, chart on the left, or you have to export your way to keep it flat, as Germany and Japan do. And again, if you look at manufacturing productivity in the US, chart on the right, it's much more productive, but wages in any emerging markets, like if any country out here than China, make that sort of negate that.